Welcome back, everyone. Thanks for joining. Today on the Joseph Carlson Show, we need to talk about some of the earnings reports of my top stocks, my very top picks. Over the past week, a lot of them reported their earnings, and Apple was one of them. In the words of CNBC, Apple demolishes their earning expectations once again. They did it quarter after quarter. They beat their earnings expectations by a lot. This was a substantial beat, but the stock really isn't rallying. It's kind of staying the same because investors are again concerned about future growth of the company. Is this the biggest that Apple will get? Do they really have a big growth path? Are they saturated? Have they already penetrated all the markets that they're working in? And do they have room for future growth? That's what investors want to know about Apple. And I have some thoughts about this because I see a lot of ways that Apple can grow substantially from where they are right now. We also, of course, have Microsoft posting big earnings beat and giving optimistic revenue forecast. And of course, we have VICI Properties, the gaming and leisure real estate company that I've built up a sizable holding over the past few months. I now have a $20,000 position into this company, so it's one of my bigger positions, and they reported earnings last week as well. It was a beat, top line and bottom line. Everything's on track with the company. But what I want to highlight with this earnings is the earnings call from the CEO. I thought it was just a phenomenal call. The CEO outlines why he thinks these properties are so valuable, how he thinks they'll attract institutional index investors in the future, and where he sees the growth path of this company. So I'm going to go over and actually highlight some of the clips from their most recent earnings call because I think it was really interesting to listen to. And of course, we have some other news to get to. Scarlett Johansson is suing Disney. We have to talk about this news. I'll dive into why she's suing, if it's warranted, and who I think is going to win. And we have Square acquiring Afterpay for $29 billion, another buy now, pay later company. So this has become a more popular thing as company after company are either building out their buy now, pay later, or they're just simply buying other companies that do the same thing. So I'm going to talk about this phenomenon of buy now, pay later and my thoughts on this overall. And then lastly, at the end of this episode, I'll be answering one of your questions. I had a viewer email in asking, is Tesla stock a buy right now? And if it's not Tesla, what would you buy in the EV market if you wanted to make a play in this industry? So I'm going to be answering that question. Is Tesla a buy? And if not, what is in the EV market? So we have a lot to get to. If you like this type of content, as always, a simple thumbs up is appreciated. Now let's go ahead and jump right into the earnings report. One of my top companies, in fact, this is my biggest holding by far, which is Apple. It's in the tech and cloud computing category. If I click into here, I see that I have around $50,000 into Apple, a little over $49,000 right now, and the gains are $13,558. Now, the company trades up and down all the time as investors reposition their portfolios. They try to figure out what they do, but that's not really what I like to pay attention to. I don't really look at the stock price intraday all the time with Apple. What I pay attention to is the fundamentals. And a lot of the fundamentals are outlined in their earnings reports quarter after quarter. Apple again demolished their earnings expectations. We can go down and look at what that actually means. Here is what demolishing your expectations means. Earnings per share came in at $1.30 versus $1.01. So they beat their earnings per share. Their revenue came in at $81.4 billion versus $73 billion expected. So they beat their revenue by what? $8 billion? That is a significant beat in revenue. It's up 36% year over year. So if someone tells you that Apple's no longer a growth company, they're completely saturated, they're slowing down entirely, highlight this earnings report. They grew their revenue 36% year over year. And then we had the service revenue, $17.48 billion versus $16.33 billion expected. They had their service revenue grow by over $1 billion over the expectations, up another 33% year over year. This is, again, the very important, high margin, resilient, sticky source of revenue. Now, all their device sales were good. They had their other revenue, Mac revenue, iPad revenue, all of that beat expectations as well. And their gross margins is 43.3% versus 41.9%. Apple continues to have tech-like gross margins of 40% plus. So even after another blowout quarter where Apple beat their top line revenue, their earnings, their device sales, their margin expansion, their service sales, every single aspect of this company grew substantially ahead of analyst expectations, the stock isn't going anywhere. It's down 0.67%. So a lot of Apple investors are sitting there saying, I own a company that's outperforming every expectation, yet the stock is not surging upwards, it's staying flat. What's going on? What gives? Gene Munster, who's an Apple analyst, talks about how expectations are the big question here, sustainability, and if this type of performance can be sustained for Apple.
Melissa, there's the stock and there's the business, and eventually the business follows the stock. They are not getting credit for the strength in the business. Up 11% versus expectations. They grew 36%. It was not that easy of a comp. It was flat a year ago. So this is impressive. And you look at the stock and wonder, what are we missing? And what we're missing, of course, is the bingo word of the day of sustainability. And so let me just quickly highlight the sustainability question.
Gina's right. The question for Apple investors is always, can this growth be sustained, or is Apple as big as they're ever going to be? It's already such a massive company with so many products, so many customers, that it's difficult to comprehend how it could possibly grow even bigger. But Gene here outlines how he thinks this company can grow substantially bigger than it is today.
75% of Apple's revenue is going to have a tailwind for the next few years. Mac and iPad from work and learn from anywhere. You have iPhone, multi-year 5G upgrade cycle. But that in itself, I suspect, will continue to power great results. And I think that we're going to be asking the sustainability question again. Each time Apple has a great quarter, investors are going to wonder how long is this greatness going to last? Which brings me to really the punchline, and it's my guiding principle around, we talked a little bit about Google, but Apple too, around innovation. And I think ultimately investors should rest well knowing that their core businesses are doing exceptionally well, and more importantly, that the company is tapping into new massive markets around transportation, healthcare, augmented reality. All of these have the potential to accelerate a $300–400 billion growth company. And so patience is going to be a virtue with this. They may not get the credit for it today. I do believe that the stock for the next year plus should be $200. But if you start factoring in some of these other markets that they're going after that I just mentioned, this could be a much bigger valuation than $3.2 trillion.
So he does believe that Apple will continue to grow from this point, and he says that although they're not getting the credit they deserve today, they eventually will. This is Apple's revenue broken down year by year based on different segments of their business. The blue category is the iPhone, the orange category is the iPad, but most importantly, this green category here. It started in 2012. It is the service business. This is the highly resilient subscription type of income that brings a lot of stability to Apple's earnings reports, and this is growing over time. In fact, if we look at this as a percentage of revenue, so broken down by percentages, you can see the green portion here, which is the subscription income. Since 2012, it went from 8.23% to last year being 19.58%. So that is the percentage of revenue. They've made it a bigger and bigger portion of their business as time goes on. And this trend will continue. As Apple continues to grow, this green part will make a bigger and bigger portion of their business, which brings a lot of stability, a lot of recurring revenue, and it is a high margin portion of revenue. So they earn double the margins with their subscriptions than they do with device sales. And even on top of the growth of their fundamental business, their services, their device sales, Apple could potentially be going into these new markets he mentioned: transportation with the Apple Car, healthcare with the Apple Watch, augmented reality. I would even add to that list potentially Apple Search. Apple could potentially compete with Google by coming out with their own search. So they have a lot of potential passive growth. And Gene mentions one more, which is Apple hardware as a service.
But I do believe their products do enrich people's lives, and I think that companies like that continue to see growth. And investors, I believe over time, we are focused on the services versus hardware. But let me just pose this, is we believe that Apple in the next year to 2 years is going to come out with we refer to as a 360 bundle. Essentially, they will offer all of their products as subscription. So you get your Mac every 3 or 4 years, your iPhone every 2 years, your watch every 2 years. It's just what consumers want. It's serviced. It works.
Now, this is something that I think will eventually happen. I agree here with Gene again. People want to have the latest devices. There's some people that trade in every single iPhone to get a couple $100 back so they can buy the newest one. They're just addicted to having the newest, latest device. And so if they had a subscription bundle where you could have every hardware device on an incremental basis, every new upgrade, and you paid one subscription, I know a lot of people that would sign up for that type of subscription. I think that would be very successful. And if that happened, what would it do to the multiple of Apple? How would investors reevaluate what this company's worth?
And then what is the multiple, to finish your question, Karen? What's the right multiple on this? I think that conservatively it should be 28 or 30 times. If they're in $7 next year, a 28 multiple gets you to that $200.
So he thinks that if Apple's able to keep the PE ratio of 28 to 30, by next year, it'll be trading in the 200s. So I'm very happy with Apple's fundamental business. I'm happy with all the various ways this company can grow. I think it has a very bright future. The question of whether or not it's a buy right now, let me put it this way. If I didn't already have such a large allocation to this company, I would be fine buying more of it today. Now let's go ahead and look at Microsoft. Microsoft posts big earnings beat, gives optimistic revenue forecast. Everything is going well with this company as well. They continue to outperform, and this is no surprise. It's really not a surprise for anybody that Microsoft performs well. They are a subscription king. Almost all of the things that they make and sell have been successfully wrapped into a subscription formula. So I've made Microsoft a large position in my portfolio, and I just sit back and enjoy this company that provides both capital appreciation and it grows its dividend year after year after year. I think that Microsoft will be one of the companies that pays an uninterrupted dividend in my portfolio for like the next 30 years. I really think it's going to be one of those companies. Now, next up, we have VICI, which of course is the real estate investment trust. I've been very excited about this company. I've invested over $20,000 into it. So this is one of my bigger investments, one of my bigger individual bets. It yields around a 4.3% yield, but they own massive properties like the Venetian, like Caesar's Palace. They own the actual building and land, and the operators pay VICI rent. So you're the landlord that owns those buildings, as well as many other experiential places like those when you invest in VICI. Now, they had their quarterly report last week, and everything was great. They beat their earnings, their top line growth, their bottom line. They reaffirmed guidance. Everything is on track for this company. But I wanted to highlight what I thought was really phenomenal about this earnings report. And that was the CEO getting on the earnings call and explaining some concepts about what he thinks is the value in this company. His name's Ed Pitoniak, and he's been the CEO of VICI since its founding in 2017. Here he is explaining how he thinks that this type of real estate, this type of gaming and leisure property, like the Venetian, like Caesar's Palace, is the next big institutional story.
But first, I want to address a topic we've talked a lot about at VICI since VICI's emergence in the fall of 2017. And that's the topic of real estate asset class institutionalization. At VICI, we've been saying since day one in October of 2017 that gaming real estate deserves to be, and we believe is proving to be, the next great institutionalization story in American commercial real estate.
Institutionalization of an asset class is something that a lot of you might not be familiar of. He goes on to define what that actually means and why it's important in the case of VICI.
When we talk about real estate asset class institutionalization, we're talking about the process of institutional capital determining that an asset class is or isn't worthy of their investment. Worthy based on the quality and demand characteristics of the real estate, worthy based on the quality of the occupant's business and its credit. This determination process requires learning, and learning takes time and hard work. And there's no question that it's active managers who pioneer investment in the listed equities of new real estate asset classes. Where active managers go, index managers follow.
Ed notes that where active managers go, index managers follow. So active managers like VICI pioneer new classes for investment, like they're doing with these gaming leisure properties, and he strongly believes that eventually the index managers, the passive managers, will eventually follow along. That later down the road, what VICI's doing will attract a lot of institutional capital and support. Next, Ed goes on to outline how big these buildings are, how complex they are, and how that works to be a massive advantage for VICI. Take into consideration that when you invest in real estate, let's say that you buy rental properties, right? If you own rental properties, odds are that you can keep them rented if you have competitive pricing, but you're always concerned about what other people are doing. What are the other rental properties charging? Are they going to undercut me? Am I going to have a tough time keeping this place rented? I know that my tenants can go right across the street to the next big rental property. Think about commercial real estate. Let's say that you rent out office space or you rent out retail space. You're always competing with your neighbors. There's lots of commercial real estate. There's lots of places these businesses can move to if your rent is too expensive, or if they don't like your property, or if you have any disagreements. Your tenants can move to the next place right next door. You have competitors all around you. If you look at VICI, they own places like the Venetian, like Caesar's Palace, where there's literally no other place to go for their tenants. The operator that runs in the Venetian has no other place. There's no other Venetian on the Vegas Strip. There's nowhere else for them to go. They essentially have no competition.
And let's start with scale. Our assets are big, really big. Pro forma for our Venetian transaction, VICI owns 63 million square feet of built real estate. And with 28 properties, our average property measures 2.3 million square feet. And why does scale matter? Because large scale tends to correlate to spatial complexity, multifunctionality, abundant reprogramming capacity, and high replacement cost, all of which add to mission criticality. Gaming operators can't simply relocate to the nearest slab-on-grade filled-up box. Our real estate isn't where in-and-out transactions happen. Our real estate is where experiences happen within built environments that aren't built simply to lease, but built to last.
So I think he's 100% correct when he says that our operators have no other option. They can't pick up and move to the next gray box on a slab of concrete like many other real estate tenants can. They have no other option than paying rent to VICI. Imagine being a landlord in this situation where you know that your tenants have no other option of where they can move. There's no competition. They can't pick up and leave to go anywhere else. That is the power that VICI has with their properties. If you own this company, you're in that situation. You have tenants that are forced to pay rent because there's essentially no other option for them. Now, that's great that these properties are massive, they're irreplaceable, but the big issue with VICI is concentrated risk. Unlike Store Capital, where their biggest tenant makes up like 3 to 4% of their rents, a very small portion, Store Capital is heavily diversified across their tenants and their buildings. VICI's not. VICI has almost all of their rents concentrated into Caesars Palace. They are the one operator that pays 70% of their rents. They have some diversification. They have the Venetian making up a good portion as well, but both of them are even more concentrated on the Vegas Strip. So with this concentration of rents into only a couple buildings and a couple tenants, does that make VICI more risky than other REITs?
This concentration of value in large assets may mean concentration of risk, but we believe this risk is offset by the high quality of these assets. We would rather have value concentrated in high-quality, non-commodity assets than dispersed across conventional commodity triple net boxes.
So Ed's counter-argument to the risk of concentration in VICI is the fact that they're high quality. They're not commodities and they can't be replaced. You compare that again to like an Ashley Furniture from Store Capital, and it's much more replaceable. It's a lot more of a commodity. You could replace an Ashley Furniture with basically any other strip mall building, but you can't do that with the Venetian. So even though VICI has concentrated risk, it may be offset by the quality and uniqueness of these buildings. Now, Ed goes on to highlight many other important parts of how high quality VICI is. Their lease duration, for instance, is averaging 34 years. The Venetian lease is 50 years, so they have tenants locked in for decades. They have rent escalation built into all of their contracts. 95% of their rents are CPI adjusted, meaning they have inflation mitigation built into their rents as well. They've really thought through every aspect of their business model, and he notes that this is the only way that you can own these type of properties.
All of these investment characteristics of gaming real estate give us great confidence when it comes to expressing our fundamental belief that gaming real estate is the highest quality, largest scale real estate that can currently be owned within a triple net structure.
Now, Ed closes out his little portion here, his little intro, I think by taking a stab at Realty Income Corp and Store Capital. Listen to what he says here between the choice of investing in VICI and investing in these other REITs.
Consider the choice between Caesars Palace, Las Vegas, a 9 million square foot asset on 82 acres on the Las Vegas Strip, the most dynamic experiential street in America, or a discount store that sits on a fraction of an acre on a secondary road in a secondary market. You can decide which you prefer.
I think that that's some shots fired at Store Capital and shots fired at Realty Income Corp. But good job to Ed. I think he's doing a very good job running this company, and I like the direction it's going. So that's a look at the earnings report of some of my top holdings, Apple, Microsoft, and VICI. I've been very happy with all of them. These companies are doing great. They continue to grow. They're earning me more and more cash flow every single month. In fact, if I look at my passive income growth that I track on Qualtrim.com, you gain access to this website and app if you're a Patreon member. There's a link in the description below if you're interested. But I track the month-over-month growth of my income. You can see this growth over time. Last month in July, I earned $430 in dividends, and my goal is to make this number go up as much as possible. On average, my monthly income is $576.24. That's my average monthly income. My goal is to get this above $750. So I'm going to keep buying as many cash flow companies as I can, and I'm going to reinvest this $576 a month I'm earning back into cash flow paying companies. So hopefully between deposits, reinvestments, and growing dividend payouts, I'll continue to grow this number to $750 as quick as possible. Now moving on, we have to talk about this news. I'm sure most of you have heard it by now. This is a very public lawsuit. Scarlett Johansson is suing Disney over the movie release of Black Widow. Ms. Johansson said in the suit that her agreement with Disney's Marvel guaranteed an exclusive theatrical release. So that's what she's saying. She's saying we had in the contract that this was supposed to be an exclusive release in theaters only, not on your streaming service. Ms. Johansson's representatives reached out to Marvel before the pandemic in 2019, seeking assurance that Black Widow would have a theatrical only release, according to the complaint. Her total salary for the project was based large part on the box office performance of the film. So in the lawsuit, she's actually alleging that Disney is conspiring against her. She says Disney intentionally made the move to prevent the actress from, quote, realizing the full benefit of her bargain with Marvel. So she's saying in order to make it so they didn't have to pay her full amount, they just released it on Disney Plus as well. And that way it cannibalized some of the revenue from the box office. Now the suit doesn't specify how much she is suing for. The decision to put the movie on Disney Plus is projected to cost Ms. Johansson more than $50 million, a person familiar with the details of her contract claimed. So this is a lot of hearsay stuff. Different claims that really aren't verified. For instance, claiming that this cost her $50 million because they released it on Disney Plus, I think is a pretty incredible claim. Because on Disney Plus, the total movie, the whole revenue for it was $60 million. So this person's claim on her contract is basically stating that she should have almost all the money that was earned off of Disney Plus. Now, Disney responded to this saying the suit has no merit, and they say, quote, it's especially sad and distressing in its callous disregard for the horrific and prolonged global effects of the COVID-19 pandemic. So they're blaming this in part on the pandemic. And let me just say, I'm a shareholder of Disney. I like their products. I like a lot of the entertainment they provide, but I do not appreciate companies using the pandemic and COVID-19 as a way to virtue signal and say, oh, we're really just concerned about the pandemic. This has nothing to do with us wanting to grow our streaming subscribers. This has nothing to do with us wanting to grow Disney Plus. This is just because we're concerned about the global pandemic. And how dare you disregard that? That is so distressing and callous. Give me a break, Disney. You're so concerned about the pandemic, but you release this movie in the box office with theaters full of people, and you have amusement parks open right now with tens of thousands of people going to them every single day. Come on, this is an incredibly disingenuous statement to make. Now, more to the point, the company said it fully complied with Ms. Johansson's contract, adding that the releasing of the film on Disney Plus with Premier Access has significantly enhanced her ability to earn more money than the $20 million she has received so far from Black Widow. So Disney's also, I think, using another strategy to point out how much Scarlett Johansson's making, saying she already made $20 million. Look at how greedy she is, right? She wants more money than that. And a lot of people buy into what Disney's selling here. They say 20 million? Wow, she's outrageously selfish. She wants more money than that. What a greedy, rich actress, right? I don't really agree with that argument. If Scarlett Johansson is owed 25 million, she should get 25 million. If she was owed an exclusive release of her movie in theaters only, then that's what should have been done. If Disney violated their contract, which is what she's claiming, she should be compensated for that. So in my opinion, this entire dispute comes down to who is telling the truth, and we don't know. Maybe her contract was breached. Maybe it wasn't. Both sides are claiming something different. So we simply don't know who is in the right and who is in the wrong, and only time will tell. But in any case, good luck to Scarlett Johansson. She's going up against the mouse, and I think that's difficult to do. Now moving on, we have the news that Square, the big fintech company, they now purchased Afterpay for $29 billion. This company Afterpay, they are a buy now, pay later company, and they are one of the fastest growing companies in Australia's history. So this was a fast growing company simply built on the premise of buying something without paying for it. That is the premise of this company. And this is a trend. The Financial Times says that buy now, pay later is becoming a boom. CNBC says that buy now, pay later is a trend that's taking off. We have Apple doing essentially the same thing. They didn't buy another company, but they built out the same thing with Goldman Sachs. Buy now and pay later. And of course, that's going to be a competitor to the rival Affirm, which is one of the companies already doing this. And then we have PayPal. They're doing the same thing. They understand that customers want to buy things without paying for it. So they have their product built out in-house. Give your sales a boost with pay later. The Financial Times says the deal underscores a huge appetite for buy now, pay later providers, which have boomed during the coronavirus pandemic. Now, the CEO of the company that was purchased said, quote, "We see real opportunities to enable the next gen consumer that's looking for different ways, and in this experience, an interest-free way of expanding the purchase potential." So that's what their vision is, to expand consumers' purchase potential, right? They say Afterpay lets consumers pay in 4 interest-free installments and pay a fee if they miss an automatic payment. So instead of paying upfront, you buy something that you can't really afford right then, and then you pay in 4 smaller installments. That's the whole basis of this buy now, pay later. So overall, I look at this deal, and we could go into the specifics of it, the Square deal buying Afterpay. We could compare it to Apple. We could compare it to PayPal. But I want to back up a little bit and just talk about this generally speaking. The whole concept of buy now and pay later is a concept I don't like. And I don't think it's good for consumers. I don't think that companies are doing this out of the goodness of their heart. I think they're further exploiting the tendency consumers have to buy things that they can't afford, to put themselves in tough financial situation, to put themselves further in debt. Do we not already have enough options to get in debt and further delay paying for things? We already have personal loans. We already have business loans. We already have credit cards. We have dozens of ways to put ourselves into debt and tough financial situations, and this is one more way. Buy now and pay later. Get the thing you want right now and suffer the consequences down the road in 4 easy installments. Now, I know that this is a tough concept that a lot of people aren't going to like, but I have to say it. If you can't pay for something at the time of purchase, you probably shouldn't be purchasing it. If you have to pay later, you shouldn't be buying it in the first place. There's a few exceptions. There's things like cars, home mortgages, right? There's college education, some things that are very important and extremely expensive that you can't possibly afford to pay up front. So there are a few exceptions, but the type of things that they outline here, that people are breaking up into payments, kids' toys should not be broken up into installments. You look at the example that PayPal has, a $150 purse broken up into 4 interest-free payments. You can buy a purse now and pay for it later. A chronograph watch that costs $750, and they advertise no interest if paid in full in 6 months. They want you to owe them for 6 months buying a watch. To finance a watch for 6 months is one of the most ridiculous things that I've ever heard. These companies are completely shameless in wanting to keep consumers poor, in locking them down into payments and purchases they should have never had in the first place. So in summary, I'm really not a fan of this trend taking off, of companies making it easier for consumers to buy things that they can't afford. Now let's go ahead and answer one of the viewers' questions. This is one email I got from a viewer. If you want to email into the show, it's joseph@josephcarlsonshow.com. Now, this one's from someone named Evan. He says, "Hi, Joseph. I want to buy into the EV market. I just feel like it's a good long-term play with the direction that Going Green is going. I'm 34 and can't imagine EV not continuing to progress in my lifetime. But what's the right stock? Tesla? I want to own that stock so bad and I'm reminded of it daily when I see more and more of them on the road. However, I still feel that the price is bloated. Charging stocks, BLNK and CHPT, not sure what the right play is, but feel dumb not at least having a portion of my portfolio being invested in EVs somewhere. Any thoughts outside of Nikola being a joke?" Don't worry about that, Evan. I'm not going to be recommending Nikola to you. If it wasn't clear from my previous episode, I'm not exactly the biggest fan of that company. Now, If I was going to pick a company in the EV territory, I'd pick Tesla. That's what I'd invest in, even with their heightened valuation right now. And I know that a lot of people say that I'm bearish on Tesla because I have concerns over the valuation. That is true to some extent. It is a riskier play because the valuation is so high that there'll be a lot of short-term volatility. But if Tesla continues to execute on their long-term vision and their long-term plan, I think the company will grow into the stock valuation. I think we'll see that over time. They're already a profitable company. They're growing quarter over quarter. Their car designs, I think, are very good. I think they're very attractive cars. They continue to come out with good products. And I also think that they're the most likely to reach autonomous vehicles and robotaxi before anyone else. So they have a lot of things going for them. And I think that they're worth the price, even right now, if you're looking for the best, most likely to succeed EV company. They have a lot of other potential competitors. Their story could change, but right now that would be my pick. Now, that's all for this episode. I appreciate you all for listening. As always, if you want to check out more content, exclusive episodes, a Discord community, you can check out the Patreon. There's lots of fun things happening there. You can try it out for free. It's a free trial, so give it a shot. Join the Patreon, see what you think. I think you'll have a lot of fun. Otherwise, I'll see you in the next episode.